Well, welcome everybody to this week's edition of Market Insights. The background looks a little different, huh? Lighting is a little funky. I'm out traveling the islands, but I didn't want to miss the opportunity to at least check in with everybody. So you have to pardon if, the picture's not as great as normal, but the information ought to be. So let's get to it. Hoping all of you are having a splendid day, had a great weekend. It is October the 7th, hard to believe. Quick reminder that everything that we do here is for educational purposes only. It is not intended as investment advice. So what's moving the markets? There's a whole lot of ugly out there. Markets are being pressured by higher interest rates. We have gone above the 4% range on the 10-year Treasury, and oil prices have spiked, mostly due to what is happening in the Middle East, but also now we've got another hurricane barreling down on the Gulf that could create a little havoc. Non-farm payrolls increased by 254,000. It was a huge beat. So kind of a proxy for the economy. All this talk about recession. You don't have a recession when employers are hiring. That was a beat by like 100,000 employees. Israel-Iran war risk heightened. I'm an amateur when it comes to what's happening in the Middle East, so that'll be my only comment. It definitely impacts oil prices. Oil prices impact inflation. Inflation impacts the markets, but it is acute as opposed to systemic. 10-year Treasury, 4.024. First time we've seen it above 4 in months. And oil prices up to $77.10 a barrel. How can you profit from that? Well, this may be a little late to jump into the game, but there is an oil ETF. USO stands for United States Oil Fund. It basically correlates to the price of West Texas Intermediate crude. Also, by stock and oil companies, they're paying nice dividends. They have relatively low PEs. Their prices have been moving up a bit recently. What to watch this week? So today and a lot of this week, whole lot of Fed speak, nothing of any real substance. We get small business optimism index will be coming out tomorrow, more Fed speak. Wholesale inventories, meaningful for the economy. I don't see that moving the market, and then a bunch more Fed speak. Then we get initial jobless claims. That'll come out on Thursday, as it always does. Get the CPI number coming out. That's a big deal. Forecast to come in at 0.1% month over month. And they think that year over year, CPI could be at 2.3%. Now, the core is still at 3.2%. They want to get that down to 2%. And then Friday, we get inflation at the wholesale level. The producer price index will be coming out, also forecasted at 0.1%. So Thursday, Friday, meaningful news. Fed job owning the rest of the week. Last week's heat map, big winner was energy. No surprise there. Industrials did pretty well. And some of the tech, not all the tech. I mean, Microsoft was down almost 4%. Apple, almost 4%, but NVIDIA up 6.5%. So it has been rocking higher. Here's your 1-year heat map, green all over the place, led by NVIDIA for the last year, up 189%. So a whole lot of stocks out there where you could have made a whole lot of money, assuming you're in the right stocks. Weekly market stats. So let's go year to date. The Dow up 12.4%, S&P 20.6%. So if you're trying to judge, your effectiveness as an investor, there's your benchmark. If you're above 21% year to date, you're doing a good job. Below 21%, you are underperforming. NASDAQ up, same as S&P. Jobs number, look at that huge boost. I mean, it had been going up after this decline in June, and that's when everybody started, screaming about a recession. I don't see that happening anytime soon. I thought this was a pretty revealing look at the stock market. This goes back to 1929, 1928. Look, market, we had the depression, went up, consolidates, goes up, consolidates, goes up over time. The market always makes people money. Now, what you want is to be able to do better than average. You want to be able to take that 10% to 15 or 20%, which is certainly possible. Full-time work, a little less common. Look at that. Companies don't want to hire full-time. And I'm getting the sense that there's a lot of employees who don't want to work full-time. Growing up, everybody wanted to work full-time, but there's been sort of a change in sentiment. And I know some companies, they'd rather have a bunch of part-time people where they don't have to pay benefits. Hours are down. So the wages, the amount per hour that companies are willing to pay has gone up, but the number of hours they'll work you has gone down. So it ends up becoming a wash to them. It's funny, the things that people fight for. Oh yeah, we'll raise your wages, but we're going to cut your hours. And some consider that to be a win. Maybe it is. Same money and fewer hours. Global rate cuts. We had more global rate cuts in September. I think there were only 3 other months in history with more cuts. So it wasn't just the US. Income versus expenditures. So US income and expenditures by quintile. So down here, the lower income, here's what's happening with their expenditures. That's what's going on with their income. Expenditures are up 9%, income's up 4%. Clearly not sustainable. Second income quintile, expenses up 13%, income up 9%. Now let's move over to the highest income group. Income up 47%, expenses up 39%. Number one rule, and I know it's easier when you make a lot of money, number one rule for long-term financial solvency, you've got to spend less than what you make. And it doesn't matter if you're down here or up here. I know some of you are thinking, yeah, if I were making $1 million a year, it'd be easy to save some money. It's easier, but it's the same discipline, right? Got to look at what's coming in, got to take a little bit off the top to go into your investment account, as hard as it is. Otherwise, life's going to be hard till the day that you die. Spend everything you make, you die broke. I grew up in a household where, my dad was a banker, never made a whole lot of money. My mom was a stay-at-home mom. What a blessing for us kids. And tell you what, they saved. We lived very modestly. We didn't have everything that we wanted, but we saved. It allowed my dad to retire at the age of 62 to a free and clear home. That's what I want for all of you. China's policies, so far, they haven't worked relative to the stock market. Look at that. Here's the S&P 500. Here's China. Now, with these new stimulus plans going into effect, I suspect we may get a turnaround here. Forward PEs, we're a little pricey. If you look at the PEs around the world, EM or emerging markets, Europe, US, we have a PE right now on the S&P 500 of 22. So the world, 19. So little pricey, but we've got all the growth as well because the big tech companies. Emerging markets are starting to gain equity share. So this is emerging market funds that include China, excluding China. There you go. More and more money. There's an ETF EEM if you wanted to check that out. October is generally the worst month of the year when there is an election. So expect some bumps. Volatility surges the closer we get to the election. Be looking for that. Fourth quarter performance in a typical year led by technology, up about 7% for the quarter. And then the worst on the list would be REITs. Market sentiment has kind of come down a bit. So last week, 49.6% of those surveyed were bullish. Now it's 45.5, still well above 37.5, the historical number. And historically, we're at 31% bearish. We're at 27.3% bearish. So people are feeling generally good about the market. Now, here's a big shift. So a few weeks ago, there was about a 65% probability of a 50 basis point rate cut. Now there's zero. There's a 16% probability of no rate cut in November. 83.5%, 25 basis points. It's going to be tough to cut rates if the economy continues along this strongly. You get a whole bunch of hiring. Unemployment dropped to 4.1%. You get a bunch of hiring. I don't know that the Fed can afford to cut without potentially triggering inflation. One-year sector return, so the S&P is up 33% for the last 12 months, so that would be your benchmark. Technology's been the leader at about 47%. Utilities, 40%. Communication, 38%. I mean, there have been winners across the board. Right? Energy is the laggard at 10%. All right, let's take a look at the charts. See what's going on out there. Let's look at the SPX. That is the S&P 500. So we crossed above this double top that was right here. Let me annotate for you. Okay. And we're holding it, but barely. So that is a key level, right around 56.50. We're at 56.92, kind of rolling over a little bit. So otherwise, we're bullish again. We're going to see plenty of volatility. That's just, the way that it's going to be. We call that October. All right. Well, I will be back with you from home next week. Be hard to say goodbye to this place. I wish you could see the view. Anyway, have a blessed week and goodbye for now.